Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the JPMorgan Global Income Fund. The JPMorgan Global Income Fund is a global multi-asset income or GMI strategy. It is one of the earliest incepted GMI products in the retail market and currently is one of the largest by AUM. So I think I should do a video to cover it. The JPMorgan Global Income Fund is not to be confused with JPMorgan Income Fund, which is a global bond strategy, and also JPMorgan Global Equity Premium Income ETF, which is a global equity strategy. It should also not be confused with the JPMorgan Global Income ESG Fund, which is a similar GMI strategy run by the same team, but focusing on ESG selection criteria for its holdings. The ESG version is way smaller, with only about $100 million AUM, and has a worse performance, so don't bother. Blame the fund providers for coming up with all these similar fund names to confuse investors. JPMorgan Chase is a leading global financial services firm with over 225 years of history and currently managing over $3.9 trillion of assets across a wide range of businesses. Chase is primarily a US-focused consumer and commercial banking brand, while JPMorgan is for global banking and financial services. JPMorgan Asset Management, as the name implies, is the asset management business for JPMorgan globally. JPMorgan Asset Management manages over $3 trillion of AUM across equities, fixed income, multi-asset, alternatives, and liquidity solutions through more than 1,300 investment professionals. These are slightly outdated statistics on their website, so I imagine these numbers would be all bigger by now. The JPMorgan Global Income Fund is a sub-fund under the JPMorgan Investment Funds fund family. JPMorgan Investment Funds is set up as a Luxembourg SICAV company structure and is UCITS compliant. The fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The JPMorgan Global Income Fund currently has 3 co-managers as per stated in the fund webpage and fact sheet. Michael is the longest serving manager for the fund since the inception in December 2008, and as per the bio, he appears to be responsible for all aspects of the fund, including asset allocation, portfolio construction, manager selection, and risk management. He has been working in JPMorgan Asset Management since 1997 and worked through various roles before focusing on multi-asset solutions. Eric has worked in JPMorgan Asset Management since 2008, though he only joined in co-managing the fund since 2017. As per the bio, he is responsible for manager selection and portfolio construction, with a focus on tactical investments in the portfolio. Gary is the co-CIO of the Multi-Asset Solutions US team and joined JPMorgan Asset Management in 2020. Bringing nearly 30 years of experience from roles in other fund providers. He was added as a co-manager for the fund in 2021. Strangely, his photo and bio are not available in the fund webpage, and I have to search in the US website to find the info. Here is a Morningstar information on the manager history for the fund. While there have been some changes in the past, Michael has been managing the fund since its inception, and Eric has been involved for over 8 years now, so the team is relatively stable, which is good for investors. The JPMorgan Global Income Fund has a pretty straightforward investment objective. That is to provide regular income through a global portfolio of income-generating securities and usage of derivatives. It is, however, too short and too vague for investors to really understand what the fund does. So let's go through the prospectus for more details. The prospectus starts off with the investment approach, which is unfortunately quite minimal in terms of details provided. From the short paragraph, we can gather that this is really a multi-asset fund, meaning it invests in both equities and bonds. There is a top-down perspective on asset class and regional levels, and the fund leverages on the research and expertise from other investment teams within the firm. The implementation approach is flexible, although there is a focus on risk-adjusted income, which reiterates that income generation is the key objective. We will see later how the fund does from a total return perspective. The benchmark gives us an indication of how the broad asset allocation of the portfolio is expected to be, which is 35% global equities plus 25% global investment-grade bonds plus 40% US high-yield bonds. The expected returns will then commensurate with this broad allocation guideline. There are mentions of hedging to euro, and that's because the base currency of the fund is euro. However, as we will go through later, most of the other currency classes are currency hedged, and therefore the benchmarks would be currency hedged accordingly as well. The benchmark is defined to serve as performance and risk comparisons. While the fund is actively managed, it does mention that majority of the holdings are likely to be components of the benchmark, so we wouldn't expect the fund to make significant deviations. For example, a major allocation into emerging market equities. There is a caveat though, stating that the fund's performance may end up meaningfully different over time to manage investors' expectations in case the fund does something drastically wrong. This follows with a long list of investment policies, although most of the paragraphs are basically stating that the fund is allowed to invest rather flexibly and without limits in most exposures. The only specific limitations are maximum 25% in MBS and ABS, maximum 20% in equity-linked notes, and maximum 3% in COCO bonds. There is also a caveat stating that the distribution payouts are not guaranteed and that the total returns of the fund can be negative at times, in case there are investors thinking that this is a low-risk or capital-protected investment product. The last paragraph states the base currency of the fund is euro, which I mentioned earlier, which is not that important as most of the currency classes are currency hedged. As the prospectus doesn't cover much on the investment approach, the fund webpage provides a marketing summary that tries to help investors understand the fund better. The graphic states that the fund covers over 10 asset classes and over 80 markets, but this is really primarily global equities and global bonds, as the fund strategy doesn't really dabble into stuff like FX and commodities. It is also clearly stated here that this is a global multi-asset income or GMI strategy. This is accompanied with a 3-pointer description. The first talks about the fund having an unconstrained dynamic allocation strategy, though I suspect it wouldn't deviate too much from the benchmark construct. The second talks about the fund being able to provide relatively lower volatility and drawdown, which we will see later when we look at the fund's performance. The third stresses that the fund's main objective is to provide regular distribution payout. It is difficult to understand what goes on in the fund without an elaboration on the investment approach. The fund tries to compensate for this with a monthly fund commentary that talks about the performance of existing allocations for the month and adjustments to be made going forward. This at least gives some details on how the fund managers assess the markets and how they would tweak the fund portfolio accordingly. As mentioned at the start of the video, the JPMorgan Global Income Fund is one of the earliest available global multi-asset income or GMI product in the retail market, having incepted in December 2008. The fund AUM is also significantly larger than most competitor funds at $20 billion currently. The benchmark is not stated in the fund webpage or fact sheet, but as we have gone through the prospectus earlier, we know it is a customized construct of 35% global equities plus 25% global investment grade bonds plus 40% US high yield bonds. Latest asset allocation breakdown is available in the fund webpage. We can see US high yield and global equity take the biggest portions at 32.6% and 29% each, followed by a long list of various sub-asset classes defined by JPMorgan. If we try to categorize them broadly, we get around 47.2% global equities related, 35.2% high yield bonds, and 17.6% in all other bonds plus cash. Comparing this against the benchmark construct, we can see the fund currently appears to be overweight significantly in equities, while underweight in the other two major components. This does make sense as equity markets have generally done quite well in the past 1 year, while bonds are facing some uncertainties in terms of interest rate movements currently. Regional breakdown, on the other hand, is less useful, as it mixes equity and bond exposures together. Nevertheless, US exposure takes about 2/3 of the portfolio, showing the investment team's view that US markets have better investment opportunities than others on relative basis. Morningstar provides regional and country breakdown for the equity exposures, but not for the bond exposures. Nevertheless, with the equity information, it is not difficult to calculate out the bond information. We can see here equity exposures are mainly US and Europe, taking 59% and 26% each. From Morningstar, we can also get equity sector breakdown, where the main exposures are technology and financials, showing the investment team's preferences at the moment. Financial measurement on equity exposures are also available, and the most important data to note is that the dividend yield is 3.28%. Now MSCI World Index only has about 1.6% dividend yield, so this suggests the equity exposures in the fund has a bias towards value or high dividend stocks. Bonds-wise, the fund provides only credit rating breakdown and average duration. We can see the high 77% exposure to high yield, showing this is one of the main components of the fund strategy and likely the main source of income generation in the portfolio. Average duration is 2.8 years, which is lower than typical bond funds in the market, currently of around 4 years. This suggests the fund is taking a defensive approach to interest rate handling currently. Again, from Morningstar, we can get some additional information on the bond exposures. For example, the government sector exposure mostly refers to EM sovereigns, as there was EM debt in the asset allocation breakdown. So that means the portfolio currently doesn't really have notable exposures in US or European sovereigns. Average credit rating at BB- suggests that there are some single Bs or even single Cs in the holdings, though not too much. Yield to maturity is at 6.72%, which is decently high for the bond exposures. Top 10 holdings list is available in the fund webpage and fact sheet, although it doesn't mean much for a $20 billion multi-asset portfolio. Morningstar shows the fund currently has over 500 equity holdings and over 2,000 bond holdings, which is massive, and it really means that at this large fund size, the managers are focusing more on the top-down asset allocation decisions rather than bottom-up securities selection, as each position won't make a significant impact to the portfolio. One thing to note though is that the fund can invest in other funds and ETFs, as seen in the top holding here. The JPMorgan Nasdaq Equity Premium Income ETF is a product I covered in another video recently, and this is a solution designed to generate similar returns as Nasdaq 100 Index, but it converts the bulk of the returns to distribution payout, which is probably the reason why it is used in this fund for income generation purposes. The JPMorgan Global Income Fund has a long list of share classes available, given it has been broadly marketed globally across various client segments for many years. As usual, we will focus on the US dollars and Sing dollars retail A share classes in this video. And even so, you can see that there are already 11 share classes listed here. As previously mentioned, the fund is base currency in euro but has currency hedging for most of its other currency classes. There is, however, one Sing dollar unhedged share class available, and we will take a look at its performance later. The fund provides accumulation share classes for most currencies, but at the same time, there are also a number of different types of distribution share classes. We will go through the differences in these distribution types in a while. Most of these A retail share classes were launched in 2012 and 2013, with the newer distribution types launched thereafter. A share classes have a management fee of 1.25% per annum. Adding other expenses gives a total expense ratio or TER of 1.45% per annum. Up to 72% of the management fee can be paid by JPMorgan AM to distributors as trailer fees. Distributors are also allowed to charge up to 5% subscription fees for A share classes, although I think anything more than 2% for mutual funds is excessive. Some distributors offer the cheaper C or I share classes that have only 0.6% per annum management fee and also 0% subscription fee. The fee differences directly translate to better performance to investors, so it is in your benefit to find distributors that allow you to invest in these share classes. Distribution history and distribution yield data for the JPMorgan Global Income Fund is not available in the fund-specific webpage. Instead, it is available via a different fund documents page where you can search for the fund and then download a PDF document that contains the distribution data for all the share classes of the fund for the past 1 year. As there are quite a number of different distribution types, let's go through their differences based on the prospectus information. I have added here the distribution frequency as well as the latest annualized yield from the distribution history document. DIV classes have quarterly distribution frequency. The fund determines an annual distribution rate, which in this case appears to be around 6% currently, and pays that out as a gross amount without factoring any fees. Therefore, the Sing dollar classes are also having about the same 6% distribution yield as the US dollar class. It is stated this distribution yield would be higher than the income generated from the underlying portfolio, so it means some capital will be used to top up for the payout. MTH classes have monthly distribution frequency. The distribution yield is determined with a similar approach as the DIV classes, and therefore it is currently also around 6% for both the US dollar and Sing dollar classes. It is mentioned these classes are intended for Asian distribution networks, so this would be the most common retail share classes available in Singapore. IRC classes also have monthly distribution frequency. IRC stands for interest rate carry, and what this means is that IRC classes factor currency hedging costs into the distribution payout instead of the NAV. So assuming the base Euro class has a 6% distribution yield, the IRC US dollar hedge class gets a higher 8.5% distribution yield because there is a positive currency hedging cost of around 2.5% currently that gets added into the distribution. Conversely, the IRC Sing dollar hedge class gets a lower 5.65% distribution yield because there is a slight negative currency hedging cost of around minus 0.35% currently that gets deducted from the distribution. ICDIV classes are similar to MTH classes, except that they are designed to have an exceptionally high distribution payout that is likely to exceed the total return of the fund. At the current 11.7% distribution yield, this will almost certainly lead to a sharp decline in the NAV over time, as it is not possible for the asset allocation of the fund portfolio to generate such a high return across market cycles. Given the share classes all point back to the same fund portfolio, it basically means that the more distribution payout a share class has, the less NAV growth it will have as well. For example, assuming the fund delivers an average of 5% per annum total return in the long run, the DIV and MTH classes pays out 6% distribution, and therefore the NAV will go down about minus 1% each year. The ICDIB class, on the other hand, pays out a really high 11.7% distribution, and therefore the NAV will go down about minus 6.7% per year. Minus 6.7% doesn't sound like a big percentage, but it means that your investment NAV will be half in 10 years' time, which is quite significant. So higher is not better, and do consider carefully what kind of distribution you really need. The basis for me using an average of 5% per annum for the total return of the fund is based on the past 10 years total return of the A US dollars hedge class, which to be exact is 4.99% per annum. Here is a 10-year chart comparing total return and NAV movement of the share class, where it can be seen the NAV gets a slight decrease over time. The JPMorgan Global Income Fund webpage provides performance data across time periods, as well as a dynamic cumulative returns chart compared to the benchmark. The chart shows quite a big and consistently widening gap of the fund's performance versus the benchmark. Performance data in the table indicates the fund has underperformed by over 2% per annum in the long run. I am quite surprised by this because the fund has a customized benchmark of 35% global equities, plus 25% global IG bonds, plus 40% US high-yield bonds, that has delivered over 7% per annum over time. If the fund manager has researched and designed this customized benchmark, knowing it would deliver decent returns, why has the fund underperformed so much? There should only be three main causes for the underperformance. The first is of course the high fee structure of the retail share classes that currently have 1.45% TER. But even if we exclude TER, it still means the fund has underperformed the benchmark by over 0.6% per annum. The second cause would be poor active decisions on asset allocation, where the fund manager deviates from the benchmark due to macro outlook but didn't turn out well. The third cause would be poor active decisions on the security selections, though this would potentially have lower impacts as the fund has over 500 equity positions and over 2,000 bond positions, making its exposures already quite close to broad markets. So I suspect the second point is the main reason for the underperformance. The fund provides some additional performance statistics in the fund webpage, though the main problem remains that it has quite consistently delivered negative alpha across all time periods. Let's run some Morningstar charts. Here is a 10-year chart comparing the fund versus iShare ETFs representing the three components of the customized benchmark. We can see the fund has performed most similar to the US dollars high yield ETF or IHYU. On hindsight, if the fund had stick to the 35% MSCI World exposure, or even actively overweighting to MSCI World, that should have boosted up the fund's returns noticeably. So unfortunately, whatever asset allocation decisions the fund has done in the past years did not help performance-wise. Here is a shorter 3-year chart that shows the fund's performance is still very highly correlated to IHYU. This means that an investor can achieve a similar return simply by investing in just IHYU, which is not good for the fund. This also means that the fund needs to significantly improve its performance, at least to the same level as its benchmark, if not better. Again, I think the asset allocation decisions would be the key area to start reviewing and improving. Despite the fund being relatively weak versus its benchmark, it is nevertheless still one of the better performing global multi-asset income or GMI solutions in the market. In this case, comparing against BlackRock, Schroders, and Fidelity products on 10-year basis. This shows that GMI strategies place too much emphasis on providing high distribution payout, but investors are actually getting less total returns through these solutions. Here is a shorter 2-year chart where I can add some of the other GMI solutions with shorter track records that I covered in other videos previously, from Manulife, Standard Chartered, and UOB. While this is a short time period and can't really show performance consistency over time, The JPMorgan Global Income Fund nevertheless is still one of the better performing solutions in this group. All these funds also have Sing Dollar hedge share classes, and the resulting performance comparison chart looks similar. All the funds have about 5% lower returns compared to the US dollar equivalents, so that means the Sing Dollar hedge classes have a currency hedging cost of around 2.5% per annum currently. I mentioned earlier that the fund has one Sing Dollar unhedged class. Performance is significantly different in the long run, as FX fluctuations have a big impact to the overall returns. This is more suitable for investors who have an active view on FX directions and potentially may switch between the Sing Dollar unhedged and Sing Dollar hedged classes to express the FX views. However, generally I would suggest to stick to currency hedged share classes and run FX investments separately from fund investments. With that, let's summarize our findings. The JPMorgan Global Income Fund is a product from JPMorgan AM, a global leading asset manager that is under the large JPMorgan Chase business. This was one of the most important retail products for the firm in the earlier days, and the amount of resources and marketing effort shows in the AUM of the fund that is significantly larger than competitor products. Having incepted in 2008 and currently with $20 billion of AUM, the fund is a clear market leader in the Global Multi-Asset Income or GMI category. The manager team looks generally quite stable. Despite some movements over the years, Michael remains a key person since inception of the fund, while Eric has been co-managing for about 8 years now. While this is a straightforward investment strategy of global multi-asset solution with the intent to provide decently high and consistent income payout, the investment process details are rather lacking, making it difficult for investors to understand how the fund works. There are some bits of information available through the marketing summary and monthly commentary, though these are not really sufficient. The fund has a clearly defined customized benchmark comprised of global equity, global IG bonds, and US high-yield indices. This gives investors an idea of the intended long-term portfolio asset allocation and is useful for checking whether the active decisions made in the fund are working out well. The fund has way too many distribution types, leading to a long list of share classes. The ones that have high distribution payout yields are clearly sacrificing NAV growth or even consistently decreasing NAV over time, which I think is really bad for investors in the long run. Performance-wise, the fund has exhibited a consistent underperformance against its benchmark over time. There are various possible reasons for this, although I think the main problem likely is poor active decisions made on the top-down asset and sub-asset allocations in the portfolio. That being said, the fund is an above-average performer when compared against other GMI funds in the market. In conclusion, the JPMorgan Global Income Fund is one of the better GMI solutions in the retail market. Fund performance, however, can clearly be improved, as the fund already has defined a better performing customized benchmark that can be easily replicated. This concludes my absolutely biased comments on the JPMorgan Global Income Fund. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.